Good afternoon, everyone, and welcome to NEPC's beginning of the year webinar. We do this at the beginning of every year and kind of have a brief overview of our market outlook, update on the company, and also sharing our thoughts for what we see coming in this this new year. So excited for you all to join us. The title of this webinar is Bubbles Brewing, Fed, Toil, and Trouble. We did use a little assistance from ChatGPT on this, so billions of dollars well spent on this webinar title. So we'll be covering a little bit of that and more kind of on AI as well today, today's session. Joining us today is our CEO, Mike Manning, and a colleague of mine, Jennifer Appel from the asset allocation team. We're going to go through a couple of things on terms of kind of an update on the company, which you'll hear from Mike. Jen and I will kind of share our thoughts on our outlook and our key market themes. And then we'll round it off with a discussion at the end, going through some questions and kind of an open dialogue between the three of us here. A couple quick logistic items. Slides will be posted on the website along with this recording. If you do have any questions, feel free to drop it in the question box here in the webinar. We'll try to get those at the end of the session. So I'm going to turn it over to Mike now, who's going to share a little bit of behind the curtain on NEPC, and let Mike run with it.
Great, Phil. Thank you very much. Excited to give everybody an update on where things are in 2025, and more importantly, for you to hear from Phil and Jen about some of our thoughts on the markets today. So when we think about NEPC, a lot of things that we do are grounded in consistency and laid out here in terms of our mission and our vision. Our goal here is to help you achieve your goals, and we understand how important that is. The way that we try and do that is by being your most trusted partner, taking our world-class research team, coming up with innovative solutions with people who are really focused on working with your type of investment program to bring you best practices and ultimately to help you achieve your client outcomes. And if we can do that, if we can have our employees have a great experience, we think that can ensure the long-term success of NEPC. So within those core tenets and consistency, we also evolve over time. So if you look here in the next page, there are a few things I wanted to highlight. Obviously, you heard from us at the end of last year about the strategic partnership that we have with Hightower Advisors. But even on the right side of the page, one of the special things about NEPC is the diverse nature of the clients that we serve. The benefit to you is that we are solving lots of different problems, each and every day for our clients, and we're able to take those learnings and leverage those across our entire client base. So you see here 6 different client segments. We've got defined contribution, which is wrapped into a bunch of these as well. So again, that our business continues to evolve and continue looking for ways to grow and continue to service different types of clients. If we go to the next page, this just gives a quick snapshot of where we were at the end of 23 versus the end of 24. So you see, a little bit of growth in the clients. We added 8 employees over that time, and at the end of the year, obviously a well-resourced, highly impactful firm with $1.7 billion in total under advisement across the whole plan. One of our key metrics every year is how we do in your eyes. And the way we measure that is through the Net Promoter Score survey that we do, every single year. And you can see that in 2024, we rated an 80.7, which is incredibly high. Anything above 50 is considered excellent. And so this is a really important metric for us. It says that we are delivering on our promise of providing great client service to you. So this is something that we ask each and every year. In 25, we'll also do a more thorough survey, so look for that late spring or early summer. So maybe just go into a few final pages. This doesn't happen. We're not able to deliver that great service, unless we've got the right team in place. And so at the end of 24, we invited Tom, Allison, and Matt to be partners of NEPC, so 3 new partners. And then if you go to the next page, we highlight 10 new principals. In the upper left-hand corner, you see Jen Appel, and you'll hear from her in just a little bit, and we'll understand why we value her so much. She's excellent at what she does, as do all 9 people here, really from across the firm. in terms of compliance, legal, operational due diligence, performance measurement from our research team. So really a broad base of people that we're continuing to recognize for the contributions that they're making, not just to NEPC, but to all of your investment programs. So with that, maybe just a quick summary. Maybe just click one more there, Phil, if you don't mind. 2024 was really a whirlwind of a year. When you think about the over 50% of the world's population voted in an election, you had the second year in a row where the market was up 20%. We've got new directions across a lot of different economies. We had the Fed finally starting to reduce interest rates. And so where we are in 25, and this is sort of continuing on the theme of the title of the Wizard of Oz, we're in a new world. And part of our job as your investment consultant is to assess the new world and look and try and identify, what opportunities or maybe what risks there are out there in terms of the investment program. So with that, I'm going to turn it over to Phil, and he's going to jump in, and then Jen will dive into a couple topics a little more deeply after that.
Great, thank you, Mike. The last 2 years might not have been a yellow brick road, just to continue the theme, but certainly paved the way by maybe an AI bricked road. When you look at the last 2 years of returns for S&P 5, we're looking at 20+% returns, which is the first time we've seen this since the late 80s. And I think there's a lot of kind of analogous data points to suggest, the market today is similar to some point in the late 90s. And I think the big question is this 1999 or is this 1996? Based on maybe some of the market action from yesterday, it feels a little more 1990, 99-ish. But at the same time, there's a lot of good reasons to expect markets to continue to do well. We have a strong economy, strong consumer, relatively healthy balance sheets across the board, both in corporate and consumer landscapes. So many reasons to expect maybe some of this can continue despite some of the whirlwind and kind of volatility that we've seen over the last year or so. And so with that, just thinking about what are we to make of markets today? When we think about, markets, one of the things that we always try to answer is, are we in a bubble or are we not in a bubble? Especially when we look at kind of markets in the last 2 years. And I think for us, when we look at U.S. equity, sentiment is high, but we wouldn't say it's not quite a bubble. There might be kind of lingering pockets of excess, throughout markets. Maybe we'll highlight a little bit of that. But overall, valuations maybe are stretched, but U.S. capital markets relatively healthy, especially when compared to the rest of the world. When we think about inflation, there is a lingering stickiness to inflation. It is not necessarily a key concern, but it's a tail risk that if we see certain conditions, inflation can really kind of sprout up over the next couple of years. That can be everything from excessive government spending to interest rates maybe coming down too quickly, depending on how the Fed acts. But all of these types of things, kind of highlight that inflation right now is sticky, but it also reconciles with a relatively strong economy. And so strong consumer spending, strong kind of economic growth, that should reconcile with an above average inflation level. And that's what we're seeing today. And we've really come down quite far from the inflation levels from several years ago. I think another important point to mention is just what's going on with the Federal Reserve. This maybe is a little antagonistic, but the Fed almost looks a bit spooked, especially as we start the year. When we think about kind of their expected policy responses in the next year or so, how they're looking at the market, they seem uncertain. They're trying to kind of grasp on what is the trends, what's changing in terms of growth, employment, and spending. And you can see in some of their forecasts, they're not quite sure how to project some of these things. And we'll have a slide on this in a few moments, just looking at how they've maybe changed some of their thoughts over a relatively short period of time. I think the last piece just to emphasize is just thoughts on diversification. Diversification is not a four-letter word. It's not a bad word. It's not something to avoid. It's at times diversification feels like a regret maximizing function, But at the same time, finding places to be more diversified, we think is really important in this market environment. And that could be, diversification in a sense of stocks and bonds. It can be diversification from the standpoint of, where you're sourcing your U.S. equity exposure. It could be diversification from a liquidity standpoint. So there's a lot of different ways to look at diversification, and we don't want to anchor on one of them, but opportunities to find more diverse sources in your portfolios, we would emphasize for this coming year. So thinking about market sentiment, looking at kind of the market sentiment that's really driven a lot of asset classes, maybe not asset classes, or trillion-dollar assets throughout the world. And so we wanted to highlight a couple of these. So we think about, the run of the Mag 7 over the last, several years, Apple, Nvidia, Microsoft, sitting at, multiple $trillions in market cap. We also wanted to compare that to some of the other things that we're seeing out there. So cryptocurrency, for example, the total market cap of crypto as of the start of the year is over $3.5 trillion. And when we think about where there may be bubbles in the marketplace, clearly kind of our eyes are on this space. Just when you look at kind of the really dramatic shift in prices that we've seen there over the last 12 months. Now, should we see a shift in that bubble or a popping of that bubble, how does it affect the rest of the market? It's really hard to understand. But history tells us, multiple trillion-dollar, multi-trillion-dollar assets that decline by a precipitous amount tend to have some sort of mark or scar they leave in the markets, and time will tell where that comes. But I think it's important just to put some of this in context. So you look at crypto, 3 trillion above, then you look at something like U.S. high yield, just over $1 trillion in total value, and that's really a sign of, to some degree, corporate debt issuance and corporate leverage is relatively low and relatively healthy amount. Just another signal that we're seeing, some pretty good stats coming out of the U.S. economy. And I think also then to put all of this in context, kind of a fun little stat to look at is all of the gold held by central banks in the world, just over $2.5 trillion. So putting that in context relative to Microsoft, Nvidia, Bitcoin, I think kind of gives you a little bit of pause when we think about kind of where wealth has shifted, especially in the last several years. I mentioned this a bit earlier, just in terms of the Fed. The Fed has shifted expectations over the last several months. Really, that is due to the election. So when we think about the Fed's inflation expectations, the Fed dot plot, which you can see here, they've moved their expectations for rate cuts and really narrowed them, especially for 2025. So 3-4 months ago, we were looking at multiple potential rate cuts coming in 2024. The Fed expectations, now we're closer to kind of 1 or 2, markets pricing something similar into that. And the only thing that's really changed, we haven't seen new jobs data, we haven't seen new inflation data that would cause them to change course from the last several months. Really, the only change is the incoming or the new administration, new Trump administration. Expectations of what Trump policies would be in terms of spending, tariffs, seem to have impacted kind of the Fed's outlook. And over the course of the year, we'll see how that actually impacts inflation. So I wouldn't anchor to market expectations today in terms of 1 or 2 Fed cuts, because I think we could see a much wider range of outcomes there over the next 12 months or so. I want to shift a little bit to just capital market assumptions. I think, as many of you know, we publish our capital market assumptions on a quarterly basis. At the beginning of the year is always kind of a more kind of focused look at our updated assumptions. I want to talk a little bit about what are the key components that drive long-term returns. So when we think about U.S. equities or S&P 500 over the last 10 years, you have roughly an equal balance of earnings growth and valuations, or PE expansion, driving returns for the S&P 500. When we look out over the last 30 years, most of that return comes from corporate earnings growth. And that should be expected. If you look back over 50 years, 100 years, the majority of returns that flows through to equity markets comes from corporate earnings growth. And as we've seen, valuations really expand over the last 10 years, that impacts our thoughts on there's a bit of a headwind going forward for markets in terms of that valuation expansion is unlikely to continue for the foreseeable future. and earnings growth will be that main source of returns. And you can see some of that here when we look at our 10-year return expectations relative to our 30-year return expectations. So just looking at US large cap, for example, we're looking at roughly a 5.5% return over the next 10 years, but something more normalized, above 7% over the next 30 years. And again, you can see that in some other areas as well, where there are some of the kind of slightly over stretch valuation multiples flowing through into markets. You look at private equity on a 10-year basis. Private equity still delivering a premium relative to public markets, premium relative to private debt, and on a 30-year basis, kind of almost a long-term or secular view. Clearly delivering kind of long-term returns for investors. So that's just a brief hit on our assumptions and our outlook. I want to turn it over to Jen to run through our key market themes.
Thank you, Phil. So now we're going to walk through these themes. Really at the start of each year, we try to identify themes and think about what will be relevant for markets this year in terms of the impact on pricing and sentiment. So for this year, you can see we have 4 market themes that we're profiling. I'll do kind of the quick hits on a few of these and then focus a little bit more on the tariffs one, since I think that is quite relevant for markets today. But if we start from left to right, just echoing some of the points that Phil mentioned, we don't believe that there is a broad bubble across markets today, but we do see some of these smaller bubbles in certain areas that are helping to drive market sentiment and momentum and really almost keeping the party going for longer than maybe many would anticipate. But of course, there is really a lack of some of the excesses that you would typically see in terms of excess supply or leverage in markets that are often associated with more of a classic bubble profile. So for 2025, why this is relevant is that as those pockets of excess evolve, that will then kind of flow through to markets and really will shape the trajectory of things overall. Second, here we have AI spending, which is in reference to the accelerating CapEx cycle from companies that are spending on artificial intelligence. This has been particularly pronounced in the top 7 names, but we are seeing some other spending by different companies, different sectors that's occurring as well. And this spending can be quite a big market force, I think, as we've seen over the last couple of years. But now there's more of a question around what's the return on investment? When will these companies start to see revenue growth or a productivity benefit related to these AI applications? And I would say this narrative is fairly timely today, given that we saw quite a big market reaction to the DeepSeek news yesterday. So that's one data point that is calling into question if this level of spending that we're seeing is needed. I think we're likely to see that markets are going to further scrutinize some of that spending if there's not a real benefit to be seen for those companies in the near term. Then we have our third theme, world affairs. This is a theme that is centered around the fact that the global geopolitical backdrop is different today than just a few years ago. We're facing perhaps more uncertainty, more volatility than we've seen in some time, and that informs how investors think about potential economic tail risks, because it generally introduces this layer of uncertainty for capital markets. I think it is fair to say, though, that a lot of the trends underpinning this theme have been in play for some time now, but especially on the back of that global election cycle that I think was referenced earlier, where we've seen a lot of government shifting hands. That brings about more uncertainty around policy outcomes for markets to digest in 2025. And while geopolitics haven't necessarily impacted returns in a meaningful way over the last few years, I think it's important to be mindful that these dynamics evolve and can shape markets in the near term, potentially bringing some surprises, both good and bad, to fruition. So now the last theme we have here is called Tariffs Explained. If we want to just flip forward one slide, as I mentioned, we wanted to profile this one in just a little bit more detail, since this is top of mind for many, as investors are trying to parse through what is a growing list of tariff proposals and to try to understand what does this actually mean for the global economy. And frankly, today we still have a lot of uncertainties around the scope, the timeline, how tariffs might be implemented, and so forth. But these details are really important because all of those aspects are going to start to shape how impactful tariffs will be for the global economy and for markets. And obviously, we've seen markets are quite sensitive to tariff headlines, and that's a reflection of the fact that tariffs do introduce more uncertainty for interest rates, for inflation, for economic growth that can start to flow through to market pricing. With all of that said, our view at NEPC is that the tariff proposals that are out there are likely to have a more muted economic impact, especially relative to what the market's pricing in. I think it's fair to say that we would be pretty surprised if all of the tariff threats that are out there were implemented in their entirety. It's possible that we could even see some of these being more of a negotiating tool, but it's also more likely to us that we're going to see kind of a phasing in of tariffs, similar to what we saw in 2018. And if that's the case, that does help to smooth any potential disruption or inflation pressures that might arise as well. But when you really peel this back, I think the important piece here is how tariffs might be implemented and starting to think about that, because the mechanics matter. There are several ways that a president can try to implement tariffs, and the method that's used is important. So in our view, it's likely that we're going to see the administration leveraging some previously imposed tariffs, because that does expedite the process meaningfully. But we've also already seen that some investigations were kicked off on the president's first day in office that could lead to some tariffs later this year. But we largely expect that those are going to be more targeted, kind of smaller scope in nature. What I would maybe draw your attention to, kind of outside the standard tariff implementation menu, we could also see the option for new legislation to be introduced. When you think under that umbrella, what we're more focused on are any things that could more permanently impact trade relations. So you might have heard some of the proposals over the last few years looking to revoke China's permanent normal trade relations status. That's one that would be a more significant economic disruption if it came to fruition. And basically all it means is that China is currently subject to the standard duty rates set forth in the US harmonized tariff schedule. But if that status gets reversed, then it moves to column 2 rates, which mean higher baseline tariffs, overall a lot fewer products that are traded freely. So this is a much more permanent solution that the president could pursue, almost like a strategic action that would reset the basis of US-China trade relations. So much more significant economic impact, and that's something that we're watching closely for this year. So that's the very quick overview of our 4 themes that we're profiling for 2025. We look forward to seeing how those evolve throughout the course of this year. But with that, we're going to kind of switch gears here and go over a few high-level considerations that we have and are encouraging investors to think about in this type of environment. I think it was mentioned a few times up front, but we are overall emphasizing diversification within portfolios. There are a lot of different ways that investors can embrace diversification through different beta or alpha opportunities, but with some of the dynamics we've highlighted today, we do see value in owning diversifying assets and encourage investors to think about what makes sense in the context of their portfolios. Separate from that, we've also kind of painted this world where market betas are quite expensive relative to history. And generally, when that's the case, alpha takes on a higher priority. So that's something that we're leaning into this year, looking at areas where we can find alpha-rich opportunities that we can exploit and really add value to portfolios. And to the extent that we do see more dispersion, more volatility in markets, as we've seen a little bit of to start 2025, that can be a good environment for alpha as well. And then finally, the last one here, it sounds a little bit odd, but we do want to be boring. This is almost a back to basics message, but spend some time thinking about some of the underlying governance items that maybe aren't the most interesting things to be spending time on, but they can be impactful. So we're encouraging our clients to conduct strategic policy reviews, thinking about, what are the best performance benchmarks to use? What are the rebalancing strategies that are in place? Should I be considering doing that today? These are kind of the little things that over time we think can have quite a big impact. And with those aspects in mind, there are just a couple of opportunities that we want to highlight today. When we think about this diversification piece, especially within equities, we're trying to look at areas of the market that still have a risk premium priced in. So we think leaning a little bit more into diversified US large cap exposure is one thing that makes sense. So introducing more value or more quality exposure, that can be additive, especially in the context of a very concentrated market index. And we certainly saw the benefit of having this type of exposure with some of the dislocation in markets this past week as well. And on top of that, even just thinking about equities outside of the US from a diversification standpoint, it could be interesting to add global equity managers to think about introducing diversification and also alpha potential for a portfolio, especially interesting if we do see a more volatile global macro environment. And then on the following slide, just where appropriate, we are encouraging investors to add strategic policy targets to TIPS. They're an interesting diversified asset for a portfolio. And when we look at the real rate backdrop today, real interest rates have normalized quite a bit relative to history. And today they're relatively attractive versus the last 10 to 15 years. So we do think that this is a good time to consider adding TIPS if they're appropriate for your portfolio and looking at introducing them if so. So bringing that all together, we just want to be really thoughtful on where we can add value to portfolios in the current environments. So ultimately, we want to stay disciplined and kind of stick to our long-term strategic asset allocation targets while also ensuring that investors are keeping adequate liquidity on hand to rebalance if we should see markets overreacting to any surprises in the coming months. So with that, I think I'll turn it back to Phil for questions.
Great, thank you, Jen. We've got a couple questions that have come in, and also we had some discussion items we wanted to hit that both kind of reconciled with those. And so as we kind of think about maybe kind of send first question your way, and then we'll hit Mike in a second. Jen, is you mentioned a bit on kind of equity implementation. I wonder if you can talk more broadly how you're thinking about equity implementation just from a strategic lens.
Sure. So when we think about global equity implementation on the public market side, we are recommending benchmark neutral weights relative to the MSCI All Country World Index, IMI. So that does include small cap exposure around the world, and it's a very diversified global investable opportunity set. What I think is interesting is the benchmark shifted a whole lot over the last couple of years as we've seen continued US outperformance. So with our recommendation, it might seem like we are maybe taking on a lot of US exposure, but given how markets have evolved, especially outside the US, that's a positioning that we feel comfortable with, especially given some of the headwinds that exist in emerging markets today that maybe warrant that kind of smaller 10 or 11% weight in the index.
Great, thanks. And I think one of the things that we've been talking a lot about internally, and kind of heard some of my comments earlier, just thinking about kind of the concept of diversification and how we should we think about it. It doesn't always feel good. And kind of, you mentioned earlier, Jen, like a be boring type message. Not that I want to emphasize that Mike is boring, but just thinking about,
Thanks,
diversification, I wonder if you could share your thoughts, Mike, just your experience over the years at NEPC, how you've kind of gone through this cycle of diversifications in favor, out of favor, and just kind of your perspective of kind of what we share with clients, kind of the culture we built internally, kind of on, how we'll try to lean into diversification at these times.
Yeah, and certainly days like yesterday in the market speak to the benefit of why you're diversified. I guess I look back at, starting here in the mid to late 90s, you had, an incredible run in the U.S. equities, and you looked at it, and you always get that regret maximization. I think you used a phrase or something like that earlier, Phil. Right when it's your patience is tested the most, then you get these multi-year runs of where diversification really plays out and has a positive impact on the portfolio. So whether it was the the TMT bubble back in 98 to early 2000, whether it was the global financial crisis and the importance of global diversification of alternative assets, the benefits they provided coming off of that. Even 22, most of our clients did really well on a relative basis in 22 because of that diversification. I think where we are now is you started with the first slide you used, 2 years with S&P up 20% rarely happens. And I think you do get tested at the top of markets. And I think for most of us in our day job, if somebody in your team had underperformed for 3 straight years, the odds are they're not going to make it for 4. That's where investing is a little bit different because those years of underperformance can actually set the spring to provide an even greater benefit. So I think it's not just diversification, it's also being disciplined in staying the course and rebalancing, which Jen talked about. It's understanding when to be dynamic if there are opportunities that are taking place, and then finally, being determined. Make sure you're testing the assumptions of what the portfolio is you're doing. Do the work so you get comfort, not just from NEPC standpoint, but as a committee. If you do the work and say, here's why we're doing this portfolio, we're thinking about it for the long term, it can help you stay the course. And then frankly, if we do get market corrections, I think, Jen, you talked about this earlier, you want to have some diversification in the portfolio so you're ready to put money back to work, and having those discussions at your committee meetings so you're prepared to act when the time is right. Because just like it's really hard to stay a disciplined course when the markets are up, it can be really hard to be disciplined and put money back to work when the markets are down. So I think that's where we can help, try and bring best practices. So anyway.
No, that's a great, go ahead, John.
I was going to say maybe just one thing to add on to that. What I was hearing a little bit in some of Mike's comments is diversification is also a term that can be used in a number of different ways. Sometimes we might think that it is different sectors, different geographies, or just having fixed income versus equities, but there are a lot of different ways that you can actually have a more holistic view of diversification within a portfolio. Even when you think about within assets, like that US large cap piece I was talking about, but thinking about diversifying liquidity sources or alpha sources in the portfolio, those are other ways that you can build a more resilient portfolio over time.
Yeah, and I think all great points, and I think emphasizing kind of the behavioral aspect of how we interact with markets and portfolios, and don't always feel good about it, but kind of staying cool when we see some big ups, and also keeping our head when markets really kind of have their downturn is a really kind of important point to think about, especially in kind of today's market environment. We have kind of a new onset of policies from the U.S. government. Folks are uncertain about how that'll flow through in terms of capital markets. We think about kind of inflation. The Fed's clearly a bit perplexed in terms of where the direction is going, but at the same time, it's important to kind of not overreact to some of these data points. We get a lot of questions on kind of the U.S. deficit. Certainly, it's high, but maybe not a main concern for the markets today. And so, just as all things, try to take in all the data points, both the good and the bad, and really kind of try to stick to kind of policy targets and strategic targets over time. One thing that did want to cover, maybe kind of hand to you, Jen, is we talked about kind of evolution in NEPC over the years, and it comes in a lot of different forms in terms of how we look to engage and work with our clients. I wonder if you could talk a little bit about Client Hub and some of our kind of shifts and updates that are coming through there, and maybe some things coming in 2025.
Yeah, and maybe just to start, for those that aren't familiar, Client Hub is a resource that we have for all of our clients to use and interact with all of the different documents and data that we have. So it's a central hub essentially for accessing all of that information. And importantly, I think instead of calling one of us up, you can do it yourself, which is great. And there's a lot of efficiency that can be built from that. But we see a lot of benefit in terms of our clients interacting with all of our materials, and maybe we spend less time with some of the mundane tasks, and we're able to engage in higher level conversations and really drill down into how these aspects can impact portfolios. So to echo your point that we've hit a lot of milestones this year, I think we're continuing to hit a lot of milestones with our client hub usage, and we expect that'll continue to grow over time.
Yeah. And just be mindful, we don't want to be too efficient because, Jen and I still want to be able to go talk to our clients and get questions, get feedback. So always kind of a balance with how we think about those things, with some great tools that are kind of rolling out. So with that is kind of all of our questions that kind of have come through. Wanted to thank everybody for joining. This will be posted on our website, the recording and slides available. So again, wanted to thank Mike and Jen for joining us today, and looking forward to a great year this 2025. Sure, there's going to be plenty of ups and plenty of interesting kind of new data points be coming through, and we are certainly here to help you with all of those. So again, thank you much, and have a great day.